Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 21st, 2026. It's actually more than a midday update. It's analysis on gold, silver, and maybe we'll get to the mining stocks. Just know that GDX will follow, just like silver does, ultimately follows gold. So gold is the big brother, if you will, and then you're going to have silver and gold follow. I'm doing this video. I want to stay on this. I do believe, as of now, it's the year is very, very young. We're still in January, but I think silver, short on silver and or the miners, has the potential to be the biggest trade of the year, from what I can see right now, most profitable. So I often talk about hitting singles and doubles like I did in the previous video. Every trade is different. Some trades I'm just looking to game oversold or overbought, oversold bounces, overbought pullbacks. And then others I'll swing for the prize. And that is, gains, well in excess of 50, sometimes 100% or more. So, all right, if you're interested, I'm going to go over the charts. We're going to start with the long-term charts. Let me see if I can make this a little bit bigger for you. Yep, we can get it in here, try to squeeze it in, go like this. I'm just trying to fit this screen recording software. Okay, so this is gold. What you can see down here, I'm just going to go over this and then I might be able to cut it off and work with the current price. This is what did I do here? Going back to the 90s, so we have about a 30-year chart on gold. Yeah, that's, no, it's 80s, late 80s, yeah. Yep, that's what it is. Okay, so we're looking at about 40 years of price history in gold, and I'm going to zoom in a little bit. And again, you can see the year breaks just down here. This is starting out in 85. There's 2000. Let me change my color of the tool here. There we go. 2000 right here. 2010 right here. 2020 right there. Okay, so you're kind of looking at the very, very big picture. Usually monthly time frames are about as far as I'll go out. And what that is, for those of you new to trading or my type of analysis, I'm referring to the candlestick period. So every candle represents 1 month of trading. So this kind of gives you the big picture, what gold's done over time. And you can see down here, into the 2000s, gold was just underperforming, was in a bear market, moving lower. And then you had put in a divergent low. You know me, I like me some divergences, and that's what it did back then. And then it broke out. We had a first initial trend line breakout, a second trend line breakout. It started a bull market. And again, I'm recapping all, what technical analysis is all about is studying past patterns in the market or any security that you're looking at, and then trying to predict where it's going to go in the future. That's, to me, the essence of what technical analysis is all about. So, all right, so you can see from about 2001, right after the dot-com bubble burst, gold embarked on a bull market, and gold back then, exactly like now, went parabolic. So what you can see here, I'm going to draw them out for you. I have a linear uptrend line on this final advance. We had a healthy correction about halfway through the bull market in gold. That was during the financial crisis. This is just something good to note for those of you, kind of new to investing or trading, that what, in the most simplistic form, what causes the financial markets, the stock market, but then a lot of related things, crypto and oil, commodities, things like that, generally speaking, to go up is liquidity and money going into it, right? More buying pressure than selling pressure. The financial crisis was a great example of liquidation. Just about everything across the board was sold because we were in a bubble. We were in not just a housing bubble. That's what most people refer to it as. It was a credit bubble. We've got one of those today. It's not being talked about as much, but either way, it's there. And I can show you charts. I'm not going to digress in this video, but I encourage you to look at, which I've shared before, the FINRA margin interest chart. You look at that, compare it to the stock market or economic cycles, and you will see that that has gone parabolic too, and or reached new highs. And Even China just put the brakes on their market, cutting back margin, increasing margin requirements because they see the frothiness too. So okay, so just keep that in mind that you're not always protected like you think you might be in a flight to safety asset when everything gets sold due to margin, forced margin selling. All right, so that's what happened. That's the financial crisis, big correction. And then gold resumed its bull market and broke that uptrend line off that low, which was linear. Then I had a longer primary uptrend line there that was taken out at this point here. But the most important one is the parabolic trend line. Now, with this screen recording software, I can't draw it. This charting platform does let me draw parabolic uptrend lines, which I like. And if you've heard me say this once, if you followed me for a while, you've heard me say it 1,000 times. Parabolic uptrends rarely end well. In fact, I've never seen one that ended well, and that's really an understatement. They usually come down pretty hard. Here, we'll do this for kicks and giggles. I'll tell you how much gold corrected off that parabolic uptrend, because when I use log scaling, it to the untrained eye that may not look like much, but when we measure right there, it was a 46% drop. So basically, you would have lost half your money had you bought in, had you got gold bug fever right at the top and bought right before that parabolic uptrend line broke. You would have been, your $100,000 would have been worth just barely over $50,000 a few years later when that bear market ended. Okay, so let's save that. And here we are again. Let's not spend too much time on it. I want to get to a few other charts, but this is where that bear market ended. The bull market started, and you can draw, which I have done here, and it fits very well. Parabolic uptrend line. That's a parabola. You might remember, from high school. The rise over run. The slope of the trend line approaches affinity as the trend line goes. The parabola goes vertical, which it has. And again, maybe this time it's different. Those are some of the most dangerous words in investing, but usually you don't end with just a mild correction and then another upward leg. It would be very atypical. Let's just say that. There are no certainties. All right, so we also had back then negative divergence, which helped to support the case, just like you had the positive AK bullish divergence at that low down there. However, you'll also note this is the RSI right here. I should have probably circled this one. That was a green. You can see when you're above the 70 level, that is overbought. And we were overbought there. Again, if I measure that out, I'm sure that's going to probably equate to over a 50% drop. You can kind of eyeball it here. We went from about 500 down to, well, whatever that is. The scaling cuts off there, but pretty good drop, right? So without exception, let's just talk about this. And another thing I say very often, I've said hundreds, if not thousands of times over the years, is overbought is a condition, not a sell signal, not a reason to exit longs, not a reason to short. It is a condition. Now, it's a condition when coupled with proper sell signals, such as breaks of support, be it price support, trendline support, moving average support, whatever it is, then that is where you are going to most likely get a correction and or a trend change. So throughout history, again, for 40 years, we don't need to go back much farther than that. This is modern history. When in this one, yeah, you kissed the 70 level there, but you were just ending a bear market, starting a new bull. Once this thing got going, you had one, and it was a healthy correction. I'm certain if I measured that out, that's well into the double digits. We were overbought there, a bigger correction, and we were overbought there, and that did it. That's all it took, and that was the high. Right here, we reached an overbought reading, and I can tell you that was more than a double-digit drop, and it was also a correction. Remember, guys, I'm looking at a 40-year chart. So from here to here, if you go down to the bottom, when we became overbought, you might have been a long-term, had iron fists with gold, but it corrected. In the correction, it fell for about 1 to almost 3 years, and it took about 4 years to get back to that level and then finally break out. These are your breakout points. We had a basing pattern here and one there. All right, so this is it. This is the chart on gold. It has gone parabolic. Yes, a parabolic uptrend can continue for some time be careful. Don't underestimate them. The biggest gains come towards the top once you start going parabolic. The daily moves and increase. And then normally when these things break, the selling will typically come fast and furious. As I've said before, typically, sometimes I'll trade gold if the charts are better, more conducive. But what I often say is, generally speaking, there are exceptions to this, but generally speaking, if you get the call right on gold, you're going to make more money dollar for dollar by going long or short silver or GDX. All right. But with that being said, if you try to take a buy or a sell signal on GDX or gold, silver or the gold miners, and you don't have a confirming reason to be long or short gold, that trade's probably going to fail. So you want to see unless gold breaks down, that's going to be once it does, your highest probability entry. And we can look at that trend line. I'm going to jump down to the shorter term charts to kind of give you zero in on how to get maybe a quicker jump on the entry price, because again, once this crowded trade does unwind, whether that is tomorrow or whether it is 8 months from now, it will most likely be a very crowded rush for the exits. And I've been doing this a long time. When those sell signals come, I'll post them. And then, if it's a week later, I'll start getting, some posts, comments. And guys, I don't mind this. I'm just going to give you my honest opinion when I do. Hey, is it too late to short? Yeah. If silver dropped 30% in a week or 2 weeks, yeah, once the parabolic trend lines break, yeah, it's probably going to go a lot lower. But the risks for a sharp counter trend oversold bounce are very high. And I don't like I don't like shorting at that point. If I already have a position, I'll give you my thoughts whether I'm going to sit tight, ride out a counter trend rally, look to add more on it, etc. All right, so there it is. So there's gold. You can replicate this. And the single most important thing I can tell you here, if you're going to try to replicate that, you have to use log scaling. Linear, aka arithmetic scaling, will give you a completely distorted. It'll look even worse as far as the how crazy. Here, and we'll do it. See, this is what it looks like. It's going straight to the moon. But what log scaling does, it puts it equalizes each candle in percentage terms, because when gold's trading at 400 an ounce and it goes to 600, that's a 50% increase, but it's a $200 increase, right? When it goes from 4,400 to 4,600, it's still a $200 increase in the price of gold, but it's not near a 50% increase, right? You'd have to go from 4,400 to 8,800. So log scaling fixes that, and I strongly encourage you, just about any asset, use log scaling on your charts. And I have to say that because a lot of trading platforms will give you a default of arithmetic scaling. Alrighty, let's move on to the next one. Let's stick with gold for a second. Let's just drop down to a weekly chart here. I think I want to use this one. As you can see, I have a lot of charts. And once again, you can see, let me try to center this as best I can for you. Okay, I can take that top part away. Now you can see the year breaks at the bottom here. We're going back to in this case, we're going back 30 years, going back into the mid to late 90s. And so you can just see the tail end of that bear market. You can see the positive, aka bullish divergence that I like to see. And then gold embarked in a bull market. And again, the nature of a parabolic trend line is the slope continues to increase as you go up. And that's what you're seeing here. And then it broke. And it wasn't the steepest parabola, really. There was also a linear trend line there that broke after that correction mode. The bear market was more orderly. And but again, I already showed you about close to a 50% drop. Breakout here, highlighted that at the time. This was the recent breakout. We had another period of consolidation. That was the recent breakout that sparked this strong move in gold. So if you zoom in, I can't use the scroll wheel on this platform like I can with the other charts that I usually cover with you, the other charting platform. So you'll just have to bear with me, or hopefully you're not watching it on your cell phone because it's going to be really hard to see. But that is a clear parabola there with a linear uptrend line there that would probably be your first support level, and could if this thing's going to keep going, if we're not going to get a much bigger drop, then yeah, maybe we need to hold that trend line. Otherwise, if it goes, let me go to silver, because that's really the one I want to focus on for targets. Before I get to silver, and then I'm gonna drill down at the end of the video. I'll go down to the intraday charts, 60 or 120-minute charts, so gold and silver futures. But let's look at the gold to silver ratio. This is something that folks that trade, invest, and track gold and silver look at. And again, as the name implies, it's simply the ratio of gold to silver, right? And we're going back 40 years. We're going to go. So what I've done here is I've put up a few lines. This is generally, of course, there are exceptions, but generally, as you can see here, it's really a support and resistance line. It was support once you get above it, then resistance. It's generally the high end of the ratio, and things got where you find value in this ratio is when it spikes really high. That means the price of gold relative to what it's been trading against silver is very high, and then there's that catch-up trade, and we talked about it. I got very bullish right here at those on silver, and I think it was right here again, citing silver would play a game of catch-up to gold. So by this, when this gets out of whack, then there's disparity or value, that for lack of a better term, silver is underpriced versus gold. And then likewise, on the downside, it's really a range. And when I study this chart, I have support here because sometimes pull drops back to that level will do the trick. A little bit better to this one right here if you look at the extreme spikes. Let me go back to this color tool here. We hit it there, got a little lower down to that deeper extreme, but you can see a lot of reactions on that level. And with just, again, I'm going back 40 years here. And over the last 40 years, as you can see, the level we've just hit, we've only come down to a handful of times. This was the extreme right here, where silver got really ahead of gold and troughed out there. The ratio did. And then silver, I can measure it for you. Let's do that just to kind of give you an idea. And what it shows you is, many takeaways. Maybe you want to shift money out of silver into gold if you're still bullish on both. Just know that the more extreme these things get, the bigger the chances are of a strong and swift correction. So what I'm going to do, this isn't perfect because it's end-of-day stuff. It doesn't show the intraday highs, but I'm measuring how much the drop in silver once it went parabolic right here. Again, I'm going to cover this in other charts right here. You can see this advance. Went up here, went parabolic, was vastly outperforming gold as evidenced by the ratio, dropped to extremes never seen, and then it took it on the chin to make that mean reversion back to where it should be. So I put a dotted line here in the middle. That's kind of the average midpoint range, and you can see it's also based on quite a few reactions, support and resistance, and so that's where we're at right now. So the bottom line is this analysis helps tell me now, again, there's no saying we can't go down. There's not anything that says we can't exceed and make a new record low in the ratio. There's really no certain. This is not a bounded indicator. I guess it would be bounded by zero on the downside, but there's no upside, bound limitation there. But keep in mind, to get to this level, I know it is at the higher end of this range. Again, these three lines, this whole area here is pretty much the trough, if you will, where that ratio bottoms out. And again, the takeaway, once the ratio bottoms out and inflects, starts going the other way, tops, let's look at silver down here. Tops are in, right? It happened there. Again, if this will let me click my arrow tool, 73% drop, multi-year bear market. It happened right here. Again, if I were to measure, this is log scaling, but that would be high double-digit drop right there as well, multi-year bear market. Right there, high double-digit drop, bear market, and right there, multi-year bear market, high double-digit drop. Okay, my point has been made. I think you can see that there. That's showing you that this outperformance, there's no, well, the charts are going to give us a clue as to when it's going to end. This is kind of painting the big picture, telling me there's going to be more alpha, more profitability, outperformance when silver drops, especially as it goes back to the mean. And when it hits extremes, when they hit the upper extremes or the lower extremes, guess what? The next stop is usually not back to the midpoint. It's to the other extreme when you get to the high end. And also keep in mind that we're coming out from extreme, unseen spikes in the ratio. That was the all-time high. This was very close, a very high extreme, not seen since this point right here, right? Since this one right here. And so that one did fall from that point all the way to the bottom. Again, we're in here, and now we're going to drill down to the shorter term charts to see when it's going to be time to engage and when it's going to be time to engage silver or gold or GDX aggressively on the short side. Or for those of you that are long, it's been a great trade, when to exit, start raising your stops, tightening your stops, set some staggered stops. There's a lot of ways to control or mitigate, damage or losses on a position. It doesn't have to be an all or none, because silver right now is extremely volatile. 5% daily swings are the norm, and we've seen swings up to close to 10% a day, which is very unusual. But my takeaway is when you have that kind of volatility, if you're running a very tight stop, you might as well just give them your shares now. They're going to take it. And you're going to just get stopped out in the day-to-day gyrations. So, but again, I like to set stop losses tactically, not just a random number, a random percent. That it does need to be within a reasonable risk-reward ratio. But when I say tactically, when I'm long security, my stop loss will usually be set just below a support level that I believe, if broken, is going to bring in more downside. And then I'm going to take it down a little. And this is just trial and error, experience. Try to put that stop out of range of the stop raids, because they tend to take in recent years, even recent decades, the algos, the market makers, the big trading desks, they know where the stops are placed. Hell, that's what they're doing. That's why you have free trades at Robinhood and Schwab and Fidelity and all these now. There's no free lunch. They're selling your data, your trade information to the exchange. Interactive Brokers caters to professional traders. I opt to pay commissions versus they also offer free trades. If you want them to sell your data, you can trade for free. I don't want that. Take it a step further. They even allow me, I hide my stop loss orders. They sit only at the broker, not at the exchange. And I do this with futures. I do it with stocks because I don't want them to see that order and come down and clip it. All right. Anywho, that's the kind of big picture. Here's silver going parabolic. Let's look at the chart of silver, and then we'll wrap this video up. All right. Okay, this is a 30-year chart. So we're going back into starting here in 1996. We're looking at 30 years of price history on silver. And silver, because it is more volatile and it is typically getting ahead of gold on the uptrends, usually after a while, even after lagging, and then catching up on the downside. But I've been trading silver, I've been trading metals, all of them, for many years, many decades. And it's the nature of this beast. It tends to go parabolic. And again, this may not look like much because, once again, I'm using linear scaling. But here, my annotation's blocking where it went. I can tell you that's a very big move right there in percentage terms. It was a parabolic advance. I have a parabolic uptrend line. It went vertical, and then when it popped, there's a great example. If you waited, if you waffled around for a couple weeks, you missed most of the drop. You certainly missed an objective entry. And before all was said and done, it dropped a total of almost 50%. The measuring tool says 48.7. It's just, I hit the highs, hit the lows. So call that 50%. But as you can see, most of that 50% drop, probably 2/3, happened right away within just a few months. Okay, and the rest of it, then it took a while to bottom out. So this is why I do these videos, guys. I do them in advance, and this is a setup. And we've taken a few shots. We've hit every time we've shorted the metals this year, last year, we hit at least one price target, if not two or more, sometimes final. And then it kept going. Some of the longer term, some of the final targets were missed on the last of the couple trades. So whether you consider that a profitable winning trade depends on whether or not you booked profits on any of those price targets or held out with a stop above entry. Again, that's like I said, that's the one reason there's impossible to track performance on the site, because I personally, and both on the site as sharing trade ideas, I often use scale-in approaches, both entering positions on different lots, only go into a full position when I have the highest degree of confidence. Also, often exiting positions, whether it's at multiple, selling some at the first price target or second price target or third, scaling out and letting some ride, or I'll do the same thing on a stop loss, a position going against me where I might not have a hard single level stop, but it may be a tiered 3-level stop. All right, so that's it. So parabolic advance, very clear. Parabolic here, broke the parabola or the parabolic uptrend line, had negative divergence, and this thing, again, there was the initial shot across the bow, the initial Pavlov's dogs bell ringing. Everyone that wanted to get in silver that didn't, for whatever reason, didn't want to buy it here, they wanted to get in here, and they bought that first counter trend bounce. Probably went up to a 50% or so fib, just looking at it, typical retracement, and then the bottom fell out. And most, if you didn't have a trading plan or stops in place, you were wiped out. That was less than a year, it fell 61%. What did it do? It went parabolic again. All right, you get the point, right? This is just the nature of this beast. And right now, 99 out of 100 folks you turn on TV, because at least the ones I read and listen to, are just foaming at the mouth bullish silver now and gold, and it's just going to keep going up. The U.S. dollar is going to be debased. We keep our debts going up. Geopolitical stability, blah, blah, blah. Fill in the blanks. Same stuff gold bugs have been talking about forever. A gold bug is someone who's permanently bullish on gold and has been citing all these things, and they got the broken clock syndrome going now because it's going up. All right, so that's it. Bear market came. That was about a 78% bear market drop. Again, after the parabolic uptrend burst. And just like always, you're going to get this, if you want to be the second mouse that gets the cheese, you can wait. You don't always get a nice re-entry point like that. Usually dip buyers are going to come in at some point. But there it was. And again, before all is said and done, the drop was 78 to the end of the bear market. And that ended with, we had a divergent low here and a nice rally. It was double digits, well into the double digits. But then the bottom was put in right there. And it had positive, aka bullish divergence. Silver went parabolic again. Fell over the next about year and a half, it looks like, a little over a year, 41%. And here we are today. I have two parabolas or parabolic trend lines. So let me get this little annotation out of the way. This is what I gave you. I posted this chart for you right last day of the year. My minimum pullback target, $35. The only thing that's changed since then, let me save it real quick. Bear with me. Save. The only thing that has changed since then, we've gone a little bit higher because, again, we're in a parabolic advance without a break of the parabolic uptrend line. I have two. I have one coming off that low right there. They come in together, and one coming off this low. And they both fit like a glove, right? And that's it. Hard stop. I don't have anything else to say. When that parabolic trend line goes, and clearly goes, if you have to squint to see it, you might want to give it the benefit of the doubt. God only knows, they keep coming in voraciously buying up the pullbacks. But I do these videos because you have to have a plan. If you don't care to exit your longs or to short silver, you don't need to listen to this video or watch it. And the takeaways are, maybe you don't want to touch it. Maybe it's too aggressive, too scary for you. I've seen this pattern so many times, dozens and dozens, if not hundreds of times over the decades, on individual stocks, on individual certain commodities, and other things at the time. And again, the I can't say it any simpler. Parabolic uptrends rarely end well, and so I think now the only difference in the 31st is, well, we haven't had a sell signal. That we certainly haven't broken the trend line. We just continued to advance really vertical now. And this is, you can see, you start, once you clearly go almost straight vertical, it's right at the end. And it doesn't last very long. Again, the gains are phenomenal. And if you're in too early on the short side, it's extremely painful. But you typically don't go vertical for too long. You're not going to go vertical for 6-8 months, a year. It's usually just a few months there, and that's what it's done. And so the only difference, again, since the 31st, I told you it would be about a 50% drop from current levels. At this point in time, I put the measuring tool up today. I didn't have it before. It now would be, if we hit that target again. That's I think a very reasonable target. They'll probably come in. There'll be a hiccup there. That would be a minimum target. About 50. That's about $53. We'll call a little shy of the $55 level. You can do the math. It's at 95 now. So if you drop down to 55, that's a little less than a 50% drop. And that would be 60 something percent right there, according to that measuring tool. And, it would very well within the realm of possibilities. It could be greater, like that 78% drop. Oh, that one was 60. And again, I'm just looking at the average when it goes parabolic. So 48, 61, 78, 41. So is it unreasonable, based on what I'm looking at here, to expect a drop of north of 50%? I think that's a very likely target, well within the realm of the average, price performance and similar technical conditions in the past. Also, look at overbought conditions, because it's just there's a lot to be said and gleaned from that. This is where we just hit recently about the 90 level. So again, I'm going back, what I'd just say, 30 years. So in 3 decades, there have only been 2 other points in that period of time. And probably if I populated this chart 40, 50 years, you're not going to see many, if any, more. 1, 2, 3. We just kissed it, right? 1, 2, 3. Well, we know the first time, before all said and done, silver fell almost 80%. That one was a correction. I'll say that. It was a correction, and followed by another high. And I could have even, I'll tell you right now, I can put another parabolic, I can see it right now with my mind's eye. Let me just draw it out. There was another parabolic, smaller uptrend, just like I have 2 on this one, but this one's a little different. So take your parabola tool, click, 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 and adjust, and that's it. So yes, there's a scenario, guys, if that silver could do. Broke that parabolic trend line, had an initial, but again, a very sharp and swift drop, but then did power up to make a new high, and it was a divergent high. So I'm going to tell you right now, that's a scenario I'm very open to. I am not married to the fact, even though parabolic uptrends typically don't end well, that one had a powerful correction, but if you held on, you actually went to a new high, then the big drop came. But so I'm open to that. I love to see a divergent high to call a major top in a security, but it's not an absolute necessity. It was not an absolute necessity there. In fact, that is right here, that peak in 2011, early 2011, was a one and done situation on the RSI, overbought, no divergence, and we entered a multi-year bear market that, before all is said and done, it dropped 78%. So to bet on that scenario, if you get it, maybe. What I'm saying is a correction like this. Oops, let me clear annotations. That would look something like this. Correction, maybe they buy it up at that first potential target I told you, around a little shy of 55, and then push on. And then at that point, maybe you make a lower high in the in the PPO and a lower high in the RSI to give you the negative divergence like that, and higher high in price. So, again, I try to see the future. I try to look at all probable scenarios. I stop myself from saying all possible scenarios because anything's friggin' possible. I don't have to tell you that. I look at probabilities. I would say this is the most probable, and but this is up there, because I do see, believe me, I hear and see and believe the fundamental reasons being cited for this run in gold. The race to the bottom with the fiat currencies around the world. It's not just the U.S. money print. Look at Japan. Look what they're doing. The ECB. So I get it, and so that we'll play it by ear, and I will continue to update this throughout the year. Now let's drill down to the shorter term charts, and we'll wrap this video up. So I'm going to save that, and let's go to the futures. Okay. If you are going to be a short seller, period, especially in a cyclical or primary bull market, whether it's in stock market and you're shorting equities, or in precious metals and you're shorting, that is extremely contrary. Very few can do it, and a lot have even given up. It's just it's something I do, something I love, and it's if I see profit potential, I'm gonna take it, and I'll take those shots. I'm going to remove that divergent high. This chart's getting a little sloppy. This is a 120 minute, so I'm going to remove that, remove this commentary. All right, so I've tweaked. You've seen this chart. I've been posting this. I was posting this in November and December, and I had to tweak it slightly to come in to capture the reaction because I had a slight violation there before and one there. Remember the Christmas whipsaw, the pre-New Year whipsaw? So now I've come in and it fits better. I always say that the charts are dynamic, and so is my analysis, meaning the charts change day by day. And if you go down to the intraday charts, they change minute by minute, tick by tick, right? So this is now a very well-fitting trend line on gold. We're quite a bit above it. Just to get to it, just to test the darn thing, you're going to have to drop 7%. And then I have, as you can see, what I call a minor uptrend line. That has broken. So that is a sell signal. This is a 120-minute chart. I'm going to get to GLD in a second. I'm going to add another line here. I'm going to give you all the support levels I see. These are both potential pullback targets. It depends on your view. There's going to be gold bugs, those bullish wanting to get in gold or add to it, listening to my voice, and there might be the select few that care to short it and catch the next drop. And whether it's just a quick pullback trade, those are very profitable. As you know, we shorted gold here. We hit price targets on gold, GDX, silver, all that. I think we took a shot at it there, and I think here. So I like these little 60-minute divergent highs and lows, but this is a very well-defined trend line at this point in time now that if and when broken is most likely going to probably bring gold back to here. 39.56. What is that going to be? Just for kicks and giggles, assume the recent high was it. That's about a 19% drop. So good for those that might want to buy back in or take profits, or let's just say you're riding this thing up and you keep raising your stops, and you get stopped out, but you want to re-enter, or you're a short seller and you're looking for a longer term swing target. Well, that's one. And I promise you, if gold drops 19%, silver's going to take it on the chin and probably drop in a multiple thereof. Wouldn't surprise me in the least to see silver drop twice as much, 40% drop, if and when that happens. So first things first, there's a little minor sell signal there based on that minor trend line. This would be an initial pullback target if hit. You can see my levels here. That's 46.57. I'm rounding off 45.78. Then the uptrend line. If the uptrend line goes, I'm going to move this one. I'm going to borrow that line and pull it a little lower right there. 44.15, 42.78, and so forth and so on, right? Now let's look at silver. SI silver futures. I personally prefer futures for trading purposes for various reasons, as I stated. Tax benefits over trading ETFs, liquidity around the clock, being able to exit or enter And have stop losses that if there's a big move, it goes against me at 3 in the morning. I can be sound asleep and my stop is hit, so I don't have to wake up to a huge move against me if something big happens. Likewise, if I have a price target that I feel very confident on, I have a sell limit order. My orders are OCO, one cancels the other, and that price target's hit at 3 in the morning. I don't have to wake up, sit down at my desk, 7 o'clock, whenever, and look and see, Jesus, the thing hit the damn target and rocketed the other way, and I missed my fill because I was trading GLD or SLV or GDX, and the futures hit the support or the pullback, the support downside price target at 3 in the morning, and then hard reverse there. The buyer stepped in, and the dang thing has moved, 5, 6, 7%. Then my order never got filled. Trust me, that is one of the big reasons why I trade futures. I can't tell you how many times. Natural gas is just almost notorious for it, hitting my price targets outside of regular trading hours when UNG is either not trading or it's not liquid enough at very early or late hours to get in and out. Plus, you have to use limit orders. You can end up chasing those things. It's just, again, preferences to futures. There's your uptrend line right there in silver futures. Silver has big divergence forming. Again, silver is just getting outright stupid with this. And look, guys, it doesn't look parabolic here because I'm coming down to a shorter term time frame. It is. I could add a parabolic trend line. I don't have the drawing tool with me now on this charting platform, but there's another, more moderate, sustainable uptrend line. So once this sucker breaks, you have a support zone here down to about $80. And once that goes, it's pretty thin. I think we'll fall pretty fast down. And that would be a nice pullback target. It would be both a nice target to cover a short and or to go long if you're looking to enter or initiate or add to a long. How much would it be? Depending on if and when it breaks down. I can't predict it now because we don't have a solid sell signal yet. But right now, if it just peaked around here, you're talking about a 37% or so drop, give or take, and that pretty much aligns with what I just told you on gold. And I didn't do those calculations before I started the video, by the way. I've traded gold and silver so long, I can know when silver has a game of catch up to play. And that's when you're going to get that multiple. There's other times gold takes off and silver's lagging behind, and that can take some time. And those are the opportunities. When you see that and it's gone on long enough, then the charts of silver start setting up. And we've done it before on this site many times over the year. I've told you I preferred silver because, it needed to play a game of catch up, or at times, sometimes GDX or whatever else, or gold is the preferred trading proxy, excuse me. All right, and for those, I always get it, and I don't mind the ETF traders. You can watch the ETFs. Gold does a pretty good job of tracking, So let's see, that island cluster top, that one never panned out, so I'm going to remove that. You miss 100% of the shots never taken, so that part isn't. Maybe we get another one, and if we do, I'll point it out. Me, done the same thing with NVIDIA and the QQQ, pointed out in the past several years, several bullish engulfing candles at lows and bearish engulfing candles at highs, some of which, the majority of which actually panned out as reversal, tops and bottoms, and some didn't, and that's it. This is, again, trading it's a grind. It's a numbers game. You take your shots, you do it as long as you have a decent case and you're not just, shooting in the dark, just taking pot shots, then it'll play out. So that last trade in gold, I gave you 3-4 targets, and it was off that divergent high island cluster top right here. And I kept our stops, the suggested stop tight, and it was hit. So whatever, I think it was down here. So a whopping 3.5%, 3.3% loss. And these are still potential price targets. I would just add one more at this point in time. I think I'd probably go there. And again, just watch for it. Gold, starting to get really gappy. And that is also, guys, a signature that a parabolic top is coming to an end. When you just start gapping up, it's we call that a buying climax. You see it on increased volume. And especially, let's get to silver. But let me go back to gold. Let me look at the 60-minute chart. There's an uptrend line comes off there. Here's those examples I made, shorting there. We hit 1, 2, 3, came almost to 4. I believe, if not mistaken, I pointed out the divergence. We might have had an opportunity to cover there. That was the 5th and final target zone, not to be hit. Regardless, when you get down this far, stops always should be at least move back to entry. And so again, is it a winning trade? Is it a losing trade? It depends if you took it and where you took profits. Now here we are, divergent high. It's just kind of a very sloppy 60 minutes, getting sloppy. There's the same divergence that I showed you on the daily right there. It spans for a while. And this is a key uptrend line. I think I have an alert set there. Not there. It is again. Now silver. Again, look, you can see silver's just stretched. Big negative divergence also here on this 60-minute chart. Equal to lower lows on the indicators with higher lows and higher highs in price. Little minor uptrend line right there. And I'd have to remark up this chart for targets. But again, I think it's when this dam breaks, it's going to be a pretty swift rush for the exits. And I would just really focus on the daily chart. You go to the daily chart, we have some potential exhaustion gaps here. And yeah, I'll tell you what, let's just maintain those previous targets right here. T1. You have the uptrend line. That would be T1. So T2, there's a little hiccup here in price, something like that. And then this other longer term trend line. So again, this is kind of a range, and this is a preferred sweet spot. That's going to be a drop down to here, that uptrend line, about 43% drop. Look at the volume. You talk about a buying climax. I think you can see my volume bars. Edit, turn that up nice and bright for everybody to see. Silver right there. Let's see what it looks like on the weekly chart. Turn off all the other lines. See, we've gone parabolic. And again, I'm using log scaling, and we've gone vertical. Here's a great example. Let me turn back on the volume. Turn it a little brighter so you can see it. And you can see exactly what a parabolic near vertical advance looks like on extreme surge in volume. Again, we call that a buying climax, just like you had right here. And again, I'm going to measure it out. That was followed by a drop of 43%. That one, well, before all is said and done, the initial drop down here was 73. And then you had the little COVID hiccup down there, took it down to about 78. And so that's it. You have a lot of evidence that we are in the final throes of a buying climax there. And I think I've laid out the potential downside for when that bursts. So again, if it's not your cup of tea, I'll continue to pump out trade ideas on individual stocks, sectors, commodities, crypto when I feel like re-engaging. I'll probably do another video soon. I haven't had any requests for it. We had a few really nice trades on that recently, and kind of just sidestepping that, letting it grind around and do its thing, waiting for the next setup there. Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.